Preparing for accounting at PSEG interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through the 3 financial statements and how they connect. I view the income statement as the period's performance, the balance sheet as the financial position, and the cash flow statement as the explanation of cash movement. Net income increases retained earnings, while depreciation reduces earnings but is added back in operating cash flow. Capital spending increases property, plant, and equipment and reduces investing cash. Debt raises cash and liabilities, while repayments reduce both. Connecting the statements helps me identify errors during the close. While answering, focus on the income statement, balance sheet, and cash flow statement. Explain retained earnings, non-cash adjustments, working capital movements, and how a transaction flows through all 3 statements. Question 2. Why are accounting controls particularly important at a regulated utility like PSEG? Controls matter because utility accounting affects investors, regulators, and customers, not just management. At PSEG, inaccurate costs or revenues could influence regulatory filings, rate recovery, or customer charges. I would expect controls over journal entry approval, access rights, capital projects, procurement, and reconciliations. Strong evidence should show who performed and reviewed each control, when it occurred, and how exceptions were resolved. That discipline supports both reliable financial statements and credible regulatory reporting. Make sure to cover financial reporting accuracy, regulatory compliance, ratepayer protection, authorization, segregation of duties, audit evidence, and the consequences of misstating costs or revenues included in regulated rates. Question 3. What is regulatory accounting, and why is it relevant to PSEG? Regulatory accounting recognizes that an approved regulator can influence when certain costs or revenues affect customers. If recovery of a qualifying cost is probable through future rates, the utility may record a regulatory asset and amortize it later. A regulatory liability generally represents amounts collected or benefits received before the related cost or customer refund. I would verify the governing order, recovery period, and probability assessment rather than recording a balance automatically. In your answer, explain the matching principle under regulatory accounting, regulatory assets and liabilities, probable future recovery or refund, rate orders, and the difference from ordinary commercial accounting. Question 4. How would you account for a major utility capital project from inception through completion? I would begin by confirming the approved project scope, budget, and capital policy. Eligible labor, materials, contractor costs, and certain directly attributable overhead would be accumulated in construction work in progress. During construction, applicable allowance for funds used during construction may also be capitalized. Once the asset is ready for intended use, I would transfer it to the correct property class, begin depreciation, and retain invoices, approvals, and completion evidence for audit support. Be sure to mention project authorization, construction work in progress, eligible direct and indirect costs, AFUDC, capitalization date, placed in service date, depreciation, and supporting documentation. Question 5. What is AFUDC, and how would you explain its accounting treatment? AFUDC represents the financing cost associated with funds tied up in qualifying construction projects before assets enter service. Rather than expensing the cost immediately, the utility capitalizes the permitted amount into construction work in progress, subject to applicable accounting and regulatory rules. When the project is completed, the balance becomes part of the asset cost and is recovered through depreciation or approved rates. I would reconcile the calculation to project balances and authorized rates. Focus on the purpose of allowance for funds used during construction, its relationship to financing costs, capitalization during construction, regulatory treatment, and subsequent recovery through depreciation or rates. Question 6. How do you distinguish capital expenditures from operating expenses? I capitalize a cost when it creates or materially improves an asset and provides benefits beyond the current period, consistent with policy. Routine repairs, maintenance, and ordinary operating activities are expensed as incurred. For example, replacing a small component to maintain existing capacity is usually an expense, while upgrading equipment to extend life or increase capacity may be capitalized. I would review the invoice, project purpose, materiality, and policy before deciding. In your answer, discuss future economic benefit, useful life, repair versus improvement, capitalization thresholds, consistency, documentation, and the impact on earnings, assets, depreciation, and cash flow. Question 7. How would you calculate and record depreciation for utility plant? I would calculate depreciation using the asset's depreciable basis, approved useful life, residual value, and applicable method. For a utility asset, the placed in service date is critical because depreciation generally begins when the asset is available for use, not when construction starts. I would record depreciation expense and accumulated depreciation, reconcile additions and retirements, and investigate unusual changes. I would also distinguish financial reporting estimates from rates or depreciation studies approved by regulators. Make sure to cover depreciable basis, useful life, residual value, method, placed in service date, component classes, changes in estimates, and the distinction between book and regulatory depreciation. Question 8. What is the difference between book value and rate base? Book value is the accounting carrying amount of an asset, generally original cost less accumulated depreciation and impairment. Rate base is the amount a regulator allows the utility to use when determining customer rates and an authorized return. The two can differ because regulators may include or exclude specific balances, apply different depreciation, or recognize regulatory adjustments. Understanding that distinction prevents me from assuming every accounting asset automatically earns a regulated return. Discuss accounting carrying value versus the regulatory investment base, accumulated depreciation, regulatory adjustments, permitted inclusions, and how rate base supports authorized returns and customer rates. Question 9. How would you account for revenue at an electric or gas utility? Utility revenue is generally recognized as services delivered, supported by customer usage, approved rates, and billing data. At period end, I would estimate unbilled revenue for energy delivered but not yet invoiced, using usage, weather, rates, and historical patterns. I would reconcile billed and unbilled balances to operational reports, investigate unusual usage or rate changes, and separately assess taxes, credits, and regulatory mechanisms. Cash collection occurs later and does not determine revenue timing. While answering, cover customer billing, service delivery, unbilled revenue, estimates, rate structures, timing under revenue guidance, collections, and reconciliation between operational volumes and recorded revenue. Question 10. What is unbilled revenue, and how would you test its reasonableness? Unbilled revenue is revenue earned from energy or other services delivered before the customer invoice is generated. I would test the estimate by reviewing the calculation methodology, current period usage, approved tariffs, weather impacts, and the billing cutoff. I would compare the estimate with subsequent invoices and prior periods, investigate large variances, and confirm that the accrual reverses or clears appropriately. The key risk is recognizing service that was not actually delivered. Be sure to mention service delivered before billing, usage estimates, cutoff, weather and rate assumptions, subsequent billing, reversals, historical comparisons, and reconciliation to metered volumes. Question 11. How would you account for fuel and purchased power costs? I would record fuel or purchased power costs when the energy or related service is received, even if the supplier invoice arrives later. That requires accruals based on contract prices, delivered volumes, market data, or operational estimates. I would reconcile invoices and accrual reversals, test cutoff around month end, and analyze price and volume variances. If a regulatory mechanism permits recovery or refund, I would separately evaluate the related regulatory asset or liability. Focus on accruals for energy received, supplier invoices, contract terms, inventory where applicable, price and volume variances, regulatory recovery mechanisms, cutoff, and reconciliation to operational data. Question 12. How do regulatory assets and regulatory liabilities affect the financial statements? A regulatory asset generally defers a qualifying cost that is expected to be recovered from customers, while a regulatory liability defers a benefit or amount expected to be returned. Initially, the balance sheet carries the item. Later, amortization affects expense or revenue as rates recover or refund it. The cash flow may occur before the income statement impact. I would maintain an amortization schedule, tie it to regulatory orders, and reassess collectibility each reporting period. In your answer, explain balance sheet classification, amortization or refund, income statement timing, cash flow differences, probability of recovery, and the need to monitor regulatory orders and remaining balances. Question 13. How would you perform a month-end account reconciliation? I start by agreeing the general ledger balance to a reliable independent source, such as a bank statement, subledger, invoice listing, or fixed asset register. I then explain every reconciling item, document its age and owner, and determine whether an adjusting entry is needed. I compare the balance with prior periods and expectations to identify unusual movements. Finally, I obtain review evidence and track unresolved items until they are cleared or properly supported. Make sure to cover agreeing the ledger to independent support, explaining reconciling items, aging open items, investigating unusual movements, review or sign off, and timely resolution of exceptions. Question 14. Describe your approach to preparing and reviewing a journal entry. Before preparing a journal entry, I identify the underlying business event and determine the appropriate accounting policy. I verify the accounts, amounts, period, legal entity, cost center, and whether the entry is recurring or one-time. Supporting schedules should clearly explain the calculation and tie to source documents. I would review the debit-credit balance, assess financial statement impact, submit it through the required approval workflow, and retain evidence for audit and future review. Discuss business purpose, debit and credit logic, source support, accounting policy, period, entity and cost center coding, approval, recurring entries, and independent review. Question 15. How would you investigate a large unfavorable budget variance? I would first quantify the variance and compare it with budget, forecast, and prior periods. Then I would separate price, volume, timing, mix, and one-time effects. For a utility, higher purchased power expense might reflect weather-driven demand or market prices rather than poor cost control. I would validate the ledger and operational data, speak with the responsible business owner, document the root cause, and determine whether the forecast, accrual, or budget assumptions need updating. While answering, focus on defining the variance, separating price, volume, timing, and one-time drivers, validating data, consulting operational owners, and determining whether forecasting or accounting adjustments are required. Question 16. What steps would you take to ensure proper cutoff at month-end? I would establish the correct accounting date from when goods or services were received, rather than relying only on invoice dates. I would review late invoices, receiving reports, project confirmations, supplier statements, and subsequent payments to identify unrecorded liabilities. For revenue, I would confirm that service was delivered before recognition. I would also review accrual reversals and transactions immediately before and after period end, because cutoff errors often arise at those boundaries. Be sure to mention goods and services received, invoices recorded after period end, shipping or service dates, accruals, reversals, revenue delivery, subsequent disbursements, and targeted testing around close. Question 17. How would you account for leases under U.S. generally accepted accounting principles? I would first determine whether a contract conveys the right to control an identified asset for a period of time. At commencement, the company generally records a right-of-use asset and lease liability, measured using lease payments and an appropriate discount rate. I would classify the arrangement as operating or finance, assess renewal options and modifications, and reconcile the lease system to the general ledger. Complete contract data is essential, especially for property, vehicles, and equipment. Cover identifying a lease, right-of-use assets, lease liabilities, operating versus finance classification, commencement date, discount rate, modifications, and complete lease data for a large utility organization. Question 18. What is impairment, and how would you assess a long-lived utility asset? I would begin by identifying indicators such as technological change, physical damage, adverse regulation, sustained underperformance, or a decision to retire an asset. I would then apply the relevant impairment model to the appropriate asset group, using supportable cash flow and fair value assumptions. For regulated assets, approved recovery can affect the analysis, but it does not eliminate judgment. I would document the trigger, valuation inputs, sensitivity, conclusion, and required adjustment. In your answer, discuss triggering events, recoverability, asset groups, undiscounted cash flows where applicable, fair value, regulatory recovery, assumptions, and documentation of management judgment. Question 19. How would you account for asset retirement obligations? An asset retirement obligation is recognized when a legal obligation exists to retire an asset and the liability can be reasonably estimated. I would record the present value of expected retirement costs as a liability and increase the related asset, then recognize depreciation and accretion over time. I would update assumptions for timing, inflation, technology, and cost estimates, recording revisions appropriately. Utility examples may include plant decommissioning, removal obligations, or environmental restoration. Make sure to explain a legal obligation, present value measurement, initial liability and asset addition, accretion, settlement, estimate revisions, and specialized utility or environmental decommissioning considerations. Question 20. How would you distinguish an accounting error from a change in estimate? An error results from using incorrect information or failing to apply the applicable guidance when the financial statements were prepared. A change in estimate reflects new information about an uncertain amount, such as useful life, expected credit losses, or retirement costs. Errors may require correction of prior period statements depending on materiality, while estimate changes are generally recognized prospectively. I would investigate the facts available at the original date, assess materiality, consult policy, and document the conclusion. Focus on whether prior information was available, retrospective versus prospective treatment, materiality, corrected periods, disclosure, and examples such as depreciation lives, bad debts, or missed accruals. Question 21. What experience do you have with the financial close process? I approach close as a controlled sequence rather than a collection of last-minute tasks. I use a calendar showing system cutoffs, subledger completion, accruals, reconciliations, review, and reporting deadlines. I prioritize high-risk accounts, confirm dependencies with operations and procurement, and investigate variances before finalizing entries. After close, I review late adjustments and recurring issues, then improve templates or ownership. Speed matters, but a fast close is valuable only when balances remain supportable. In your answer, cover close calendars, dependencies, recurring entries, reconciliations, accruals, variance review, cross-functional coordination, deadlines, and improving quality without sacrificing control. Question 22. How would you use Excel or data analysis in an accounting role at PSEG? I would use Excel to reconcile detailed transactions to the general ledger, analyze trends, and identify exceptions efficiently. Pivot tables can summarize costs by project, vendor, or month, while XLOOKUP or similar functions can match subledger records and flag missing items. I would apply validation checks, protect formulas, preserve source data, and document assumptions. For larger files, I would consider Power Query or system reporting, while independently validating totals before relying on the output. Be sure to mention reconciliations, pivot tables, lookups, exception testing, duplicate detection, audit trails, data validation, automation, and independently checking spreadsheet outputs. Question 23. Tell me about a time you found and corrected an accounting discrepancy. In one reconciliation, I noticed a balance was materially higher than the prior month despite stable activity. I traced the difference to an accrual that had not reversed after the vendor invoice was posted. I confirmed the invoice, reviewed the recurring entry setup, prepared the correcting entry, and obtained approval. I then added a review step comparing accruals with subsequent invoices. The result was a cleaner close and a control that reduced the chance of recurrence. While answering, use a clear situation action result structure. Explain the analytical steps, root cause, communication, correcting entry or control improvement, and measurable impact. Question 24. How would you handle an accounting issue when the business owner disagrees with your conclusion? I would first understand the business owner's facts and objective, because disagreement may reflect information I have missed. I would explain the accounting conclusion using policy, source documents, and the financial statement impact rather than personal opinion. If judgment remains, I would document alternatives, assumptions, and materiality, then consult the controller or technical accounting team. I would stay respectful and solution-oriented, but I would not compromise accurate reporting to meet a preferred result. Discuss listening, facts, accounting guidance, policy, documentation, escalation, professional skepticism, and maintaining a collaborative relationship while protecting reporting integrity. Question 25. Why do you want to work in accounting at PSEG? I am attracted to PSEG because its accounting environment combines complex infrastructure, significant capital investment, operational data, and regulatory accountability. That combination would let me apply core skills such as reconciliations, fixed asset accounting, variance analysis, and controls while learning how utility decisions affect customers and long-term reliability. I also value work where accurate reporting has a broader public impact. I would bring curiosity, disciplined execution, and a willingness to partner with operational teams. Make sure to connect your accounting skills with PSEG's utility operations, regulated environment, infrastructure investment, public service mission, professional development, and the importance of reliable financial information. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.